Welcome to the deep dive. We take your source material, articles, notes, whatever you've got, and we pull out the key insights, the stuff that really matters, so you can get up to speed fast.
Yeah, think of us as filtering the noise for you, pinpointing the core information in the materials you provide.
And today, we are plunging into AbCellera Biologics. That's ticker ABCL. We're using the analysis you gave us, looking at it like a value investor, focusing on data from, let's see, May to early June 2025.
Exactly. And our goal here is pretty straightforward. Help you really grasp what AbCellera does, how its business model works, especially with revenue, its current financial picture, and, the big risks and opportunities laid out in this analysis.
Okay, let's jump right in because there's something, well, kind of puzzling about AbCellera right off the bat. Did you see this? The stock price, it was over $70 after their IPO. Huge success with the COVID antibody.
Yeah.
Right. And then early June 2025, it's trading around, what, $2.30, $2.40? That is a massive, massive drop.
It really is. And what's so striking in the analysis is comparing that price to where analysts think it should be. Their price targets are way up there.
Like how far off?
Well, the averages mentioned range from over $8 to maybe even above $21 in some cases. That suggests, potentially huge upside from where it was trading over 250% based on recent prices.
Okay, so that's the puzzle we're digging into. How does a company go from that peak, that pandemic hero status, down to these lows? But analysts still see massive potential. We're going to unpack that, sticking strictly to the analysis provided.
Right. And that disconnect, between the current market price and what analysts see as potential value, that's exactly what makes a deep dive like this so interesting from a value perspective.
Before we go any further, if you're finding this valuable, please do hit that like button and subscribe to the Stock Analytics AI YouTube channel. It honestly helps us a lot.
And just a reminder, we have that membership offer. For just €4.99 a month, you can give us a ticker, and we'll prioritize a deep dive, just like this one, specifically for you. We often get into detailed earnings analysis, too, when it's relevant.
Definitely stick around till the end. We've got a final thought that kind of pulls together AbCellera's current challenges and that long-term promise. It's a real biotech head-scratcher.
Okay.
All right, first things first. Let's get a handle on the basics. What exactly is AbCellera Biologics? What do they do?
So the analysis paints them as a technology company, but operating squarely in the biotech space. Their core is this really advanced platform powered by AI, artificial intelligence.
Okay.
And it's all geared towards discovering and developing antibody medicine. So they're merging, high-tech AI and machine learning with the actual biology.
Got it. And the business model. How does this fancy AI platform actually make them money?
It's built around partnerships. So they work with other pharma companies, other biotechs. Revenue comes in a few ways. First, partners pay them research fees upfront to use the platform for discovery work. That's probably the most stable part.
Okay, upfront fees. What else?
Then they can earn milestone payments. These kick in as drug candidates found using their platform move through clinical trials, phase 1, phase 2, etc.
Right, hitting those development markers. And I guess the big one is royalties of excess.
That's the potential home run, yeah. Royalties on actual drug sales if something makes it all the way to market. But, and this is a big but, it's very long-term, very uncertain. Biotech failure rates are high, so this makes their overall revenue pretty lumpy and unpredictable.
Which brings us to something absolutely critical in this analysis, that huge shift in their revenue lately.
This is totally central to understanding where they are now. They had this massive temporary boost from bamlanivimab, that COVID antibody they did with Eli Lilly. Huge royalties, high margins, but it was temporary.
Because the emergency use authorization got pulled, right, as the virus changed.
Exactly. So overnight, essentially, that huge chunk of profitable revenue vanished. They went back to relying mainly on those research fees and the early stage milestones, which are, well, lower margin and less predictable.
Wow. Okay. So that transition is key to understanding their current financials and why the market might be so hesitant.
Absolutely. They're now focused on building a broader base, getting more partnered programs moving forward to create more diversified, sustainable revenue streams. It's a rebuilding phase, in a way.
And the platform itself, that's the main offering they provide to partners.
Yes, that's the core. It's described as this proprietary, full-stack AML discovery engine. The analysis mentions integrated tech, high-throughput screening, automation, basically a whole system designed to make antibody discovery faster and hopefully more successful.
But it looks like they're not just doing it for partners anymore. The analysis mentions their own pipeline.
That's right, and this is a really important strategic shift. They're now developing their own drug candidates internally. The main one highlighted is ABCL 635.
What's that for?
It targets something called the NK3R receptor, aiming to treat menopause hot flashes. And what's significant is it's the first candidate from their specialized platform, the one focused on really tough targets like GPCRs and ion channels, to actually enter clinical trials. They got the green light from Health Canada for phase 1 back in May 2025.
Okay, developing their own drugs. That sounds riskier, but maybe more rewarding.
Exactly. Higher risk, higher reward. It means much bigger R&D spending and taking on the full clinical trial risk themselves. But if ABCL 635 or others succeed, they keep a much, much bigger piece of the pie compared to just getting royalties from a partner. It's a move to capture more value.
Let's talk market position. The analysis puts their market cap in early June 25, somewhere between, say, $700 and $730 million, which, again, compared to that peak price, over $70 after the IPO.
It's night and day. That IPO was December 2020. The current price, around $2.40, is drastically lower. And remember, they raised over $500 million, $555 million in that IPO.
And the analysis points out something crucial about their cash. With all that cash, their enterprise value is probably way lower than the market cap.
Correct. End of 2024, they had roughly $653 million in cash. So if the whole company's valued by the market at, say, $710 million.
The actual business, the platform, the pipeline, it's being valued at, what, $50, $60 million?
Yeah.
Barely above the cash.
That's what the numbers strongly imply, yeah.
Well,
Especially when we look at the price-to-book ratio later, it signals a lot of market skepticism about the value of their technology and future prospects right now.
but the platform is being used, right? The analysis mentioned a lot of programs.
It does seem quite active. End of 2024, they had 96 partner programs initiated where they have downstream rights, and 16 molecules discovered on their platform were already in clinical trials being run by partners. Overall, something like 100-plus programs started with over 40 different partners.
So despite the low market valuation, partners are definitely signing up. What's the main draw for them? Why use AbCellera?
According to the analysis, speed, scale, and tackling tough targets. The AI platform is supposed to make R&D much more efficient, increase the odds of success, and speed things up compared to old-school methods. Plus, they can go after challenging targets, like those GPCRs, that maybe others can't handle as easily. Now, thinking bigger picture, the industry itself. Antibody discovery is growing.
Yeah, the analysis cited some numbers. Around $8.7 billion in 2024, projected to grow like 10% a year, hitting over $22 billion by 2034. And the whole antibody drug market is already massive, over $200 billion.
And what's driving that growth?
Things like personalized medicine, biosimilars,
Yeah.
but also, critically, tech advancements, AI, machine learning, single-cell analysis, precisely the areas AbCellera is focused on.
Makes sense. Who are their main competitors then?
Well, the analysis lists some names like HECHMED or Xenon, but clarifies the direct competitors are other platform providers, companies like Adimab or OmniAb. Also, broader AI drug discovery firms like Schrödinger or Recursion. And, importantly, you can't forget the big pharma companies building their own internal discovery engines.
Right, the internal capabilities are always a threat. Now, there was a really interesting point about the FDA.
Yeah, the animal testing thing. April 2025 announcement.
Exactly. The FDA is planning to phase out mandatory animal testing for certain drugs, including antibodies. They want to replace it with what they call new approach methodologies, or NAMES.
NAMs.
Sure.
Computer modeling, AI, that kind of stuff.
Precisely. Computational models, AI, organoids. The idea is faster, safer, cheaper development, less animal use. And the FDA is even planning a pilot program specifically for antibody developers using these NMs.
That sounds like it plays right into AbCellera's hands.
It could be a major tailwind. Their whole platform is built on this kind of tech-forward, data-driven approach. If they can show their methods meet these new FDA expectations, it could seriously streamline development for their partners and make their platform even more attractive.
Okay, huge opportunity potentially.
Yeah.
But what stops someone else just building a similar AI platform? What are the barriers?
The analysis lists several. Huge upfront cost, for one. R&D, specialized equipment, data infrastructure, building a GMP manufacturing plant like they did, that takes serious capital. Then there's developing the proprietary AI itself, building the expert team. And you need a track record that bamlanimab's success actually helps build trust. It's the whole integrated package that's hard to copy quickly.
Yeah.
Data network effects might also play a role down the line.
So pulling this chapter together, Why does understanding all this, the business model, the revenue shift, the industry trends like the FDA move matter for you listening?
It sets the stage. It explains why the financials are what they are, why the stock has struggled, but also where the potential upside could come from. You see how their core technology lines up, or potentially lines up, with where the industry and regulators are heading.
Okay, let's pivot to the people running the show management.
Led by co-founder and CEO Dr. Carl Hansen. The analysis highlights their journey from university spinout, landing big partners like Pfizer, winning that DARPA contract for pandemic response tech.
Right, the P3 program.
Yeah. Then the incredibly fast bamlanivimab development, the big IPO, building out the GMP facility. Quite a track record.
How have they handled bumps in the road?
Well, bamlanivimab itself was a rapid response to a crisis, which looks good. The current challenge is navigating life after bamlanivimab. Their response, investing heavily in R&D and building that internal pipeline, looks like a proactive strategy to diversify and tackle that revenue volatility we discussed.
Did they seem transparent? How's their communication?
Seems pretty standard for a public company, based on the analysis. Quarterly earnings calls, webcasts, investor website, press releases for things like the ABCL 635 news, detailed SEC filings. The usual channels are there. So, summarizing the view on management from this analysis. Capable, honest, shareholder-focused. Capable. The track record suggests, yes, scientifically and operationally. Honest, transparent, appears standard. Shareholder-oriented. This is where the analysis really emphasizes one point. Yes, largely because of the exceptionally high level of insider ownership.
Okay, let's talk more about that insider ownership. It really stands out.
It's definitely a key point in the analysis. Dr. Hansen, the CEO, owns about 20.8% through a holding company. And if you look at the whole group of directors and executives, just 7 people. They collectively owned almost 29% as of early April 2025.
Wow, nearly a third of the company owned by the top brass.
It's significant. That's what you call serious skin in the game. Their personal wealth is deeply tied to the company's performance and the stock price going up. It creates a very strong alignment between their interests and the interests of outside shareholders like you.
Makes sense. Now, where are they putting the company's money? Capital allocation.
A lot is going back into the business. R&D spend was big, $167 million in 2024, funding the platform and that internal pipeline like ABCL 635. And huge investment in buildings, a new HQ, and that big GMP manufacturing facility set to open in 2025.
So using that IPO cash to build for the future, basically.
Exactly. That $555 million fueled this major reinvestment. It's textbook growth, biotech behavior focus on building assets and capabilities now for potential payoff later.
Not much M&A activity recently, though.
Doesn't seem like it. They bought OrthoMab back in 2020, but the analysis suggests the current focus is organic growth, R&D, partnerships, building their own pipeline.
And definitely no share buybacks or dividends.
Correct. No history of either. Which makes sense for a company in this heavy investment phase. They need the cash for growth, which leads to return on invested capital, ROIC. Currently negative.
Yeah, if they're losing money, that makes sense.
Right. The analysis pegs it around -0.15, reflecting the current losses. A huge difference from FY 2020 when bamlanivimab briefly made them profitable and ROIC was positive. The focus now isn't current ROIC, it's the potential future ROIC from all these investments paying off someday.
So what's the takeaway for you regarding management and how they're spending money?
That high insider ownership is a big positive signal commitment alignment. But the heavy spending means they're burning cash. So you need patience and faith in their long-term strategy. They're clearly prioritizing future potential over short-term profits right now.
Let's dig into those financials now. What do the numbers actually show?
Well, they really illustrate that post-COVID transition starkly. Market cap, as we said, hovering around $730 million recently.
TE ratio is negative, obviously, because of the losses.
Right. You see figures like -4.3 or -3.6 mentioned, tells you immediately valuation isn't based on earnings. It's based on hope for the future, basically.
And that revenue trend.
Yeah.
It's just wild.
Absolutely dramatic. From $233 million in 2020 down to under $29 million in 2024. And Q1 2025 even missed estimates, coming in really low at $4.2 million. It just hammers home how tough it is to replace that one-off COVID revenue.
Profit margins must be terrible then.
Deeply negative, yeah. FY 2024 saw a net loss of about $163 million. You see margin figures like negative 500%, mega 700%. It just shows how much their expenses, especially R&D, $167 million in G&A, $73 million, dwarfed the revenue in 2024. Again, total flip from 2020.
How about debt levels?
Very low, historically and currently. Seems prudent. They're not funding these losses with borrowed money, primarily using equity and other non-dilutive sources.
Okay, and free cash flow, also negative.
Definitely. Running at about negative $189 million on a trailing basis in early 2025. Completely expected given the losses and heavy investment. Mirror image of the positive cash flow during the bamlanivimab peak. Okay, let's come back to price to book, because the analysis suggests this is maybe the most telling financial metric right now.
Right. The PB was cited around 0.59 and price to tangible book at 0.65.
Yeah, a PB below 1.0 is a big flag. Remember that cash balance over $650 million end of 2024? The market cap was only slightly higher, around $710 million.
So the market is essentially valuing everything else, the AI platform, the pipeline, the partnerships, the whole operation at next to nothing, maybe $50 million or so above the cash.
That's exactly what a PB below 1 suggests in this context. It screams market skepticism. It highlights that disconnect we started with. The price reflects the current pain and seems to give almost zero credit for the potential future value of their core technology and assets.
Looking at overall financial stability, earnings consistency is clearly not there.
Not at all. Huge swings from profit to big losses, all driven by that COVID one-off.
Debt management looks sensible, though. Low debt.
Yes, seems prudent, relying on their cash pile.
And that cash pile, the liquidity, is a major strength.
Absolutely critical. That $653 million cash plus another $186 million in non-dilutive funding gave them roughly $840 million in available liquidity end of 2024.
That buys them a lot of time, right? A long runway.
Hugely important. It allows them to keep operating and investing through this cash burn phase without having to immediately run out and raise more money, likely on unfavorable terms given the stock price, assuming they manage the burn rate, of course. So, bottom line on financials. Profitable? Nope. Big losses. Strong balance sheet. Yes, from a liquidity perspective, lots of cash, little debt. That's the lifeline.
So for you, the listener, what's the distilled message from these numbers?
It tells you this isn't about current performance. It's a story stock, a bet on the future. The cash is their safety net, funding the journey. And that super low price-to-book ratio basically asks you to judge what that platform and pipeline are really worth, because the market currently values them very, very low.
Okay, let's shift gears to external factors. Market sentiment and even things like tariffs.
Market sentiment has clearly been rough. High volatility, the stock price falling off a cliff from the peak, hitting that all-time low around $1.89 in April 25. It screams caution, even bearishness in the short term.
A real show-me story for investors.
Totally. The analysis even mentions technical indicators like a low RSI, suggesting it might have been oversold near those lows, maybe hinting at sellers being exhausted, but you never know for sure.
But then on the flip side, you look at those analyst targets, it's like a different company.
Right, back to the puzzle. Average targets way up there, $8, maybe $21 plus ESIS, implying that huge potential upside over 250%. And the general consensus among analysts cited is buy or strong buy.
But there's a massive range in those targets, isn't there?
That's super important. Targets from $5 all the way up to nearly $30. That huge spread tells you just how uncertain valuing this kind of biotech is. Analysts are making wildly different guesses about clinical success odds, timing, market share. It underlines the high-risk, high-reward nature.
Did recent news move the needle much?
Mixed signals. The positive news about ABCL 635 getting phase 1 approval in May gave a little bump, but it didn't last. Then the Q1 earnings miss shortly before that likely dampened spirits. So clinical progress is good, but financial misses seem to be weighing more heavily right now.
What about short sellers and options traders?
Significant short interest noted, about 22.5 million shares shorted, maybe 11% of the float. So a decent chunk of the market is actively betting against the stock.
But the options market tells a different story.
Kind of. The put-call ratio mentioned is very low, 0.22, meaning way more open call options, bets and the price goes up, than put options, bets it goes down. So you have this tension. Bearish stock bets versus more bullish options activity, or maybe just hedging, creates potential for a short squeeze if good news hits.
Okay, now let's talk about those U.S. tariffs from 2025 mentioned in the analysis.
Right. These new tariffs hit various imports, a general 10%, but much higher on some things like Chinese APIs, and importantly, 25% on medical devices from Canada and Mexico, and potential duties on finished drugs too.
How might that impact AbCellera?
Could hit them in a few ways. Higher R&D costs if they import supplies that get tariffed. Their Vancouver GMP facility could face issues, higher costs for imported inputs, or maybe tariffs on finished antibodies going into the U.S. market, depends on the specifics. Could also disrupt supply chains, forcing them to find new, maybe pricier suppliers. And indirectly, if their partners face higher costs, maybe they cut back R&D spending.
But the analysis also saw a potential silver lining.
Yeah, this is interesting. That Canadian GMP facility, being North American but not U.S.-based, could actually become a strength. With U.S.-China trade friction, partners might really value a secure North American supply chain partner. AbCellera's integrated discovery to manufacturing in Canada could suddenly look much more appealing for de-risking things.
So for you, how do sentiment and tariffs fit into the overall picture?
They add more layers. The negative sentiment and low PB show the market's current focus on challenges. The high analyst targets show the perceived potential. Tariffs add risk costs, supply chain headaches, but also potentially boost the strategic value of their Canadian manufacturing. It's about weighing these shifting dynamics.
Let's quickly revisit ownership. We know insiders own a lot.
Yeah, that's the main story. But the analysis also notes significant institutional holders like Baker Bros. Advisors, a well-known biotech specialist with over 9%. Having sophisticated investors like that on board can be a positive sign.
But really, it's about that insider chunk.
It absolutely dominates the picture.
Yeah.
Hansen's 21%, plus the other execs and directors, nearly 29% owned by the core leadership team.
That gives them huge influence, right?
Definitely. Add Baker Bros., and you've got well over a third of the shares concentrated with insiders and one major institutional holder. Allows them significant control.
So for you listening, what's the main takeaway from this ownership structure?
It's that powerful skin in the game. Management's financial fate is locked in with the companies. It's a strong alignment of interests. Yes, high concentration can sometimes entrench management, but the primary signal here is deep commitment from the founders. The analysis mentions standard governance stuff too. Audit committees, independent directors, pay linked to performance. But honestly, that huge insider stake is the most defining governance feature here.
Okay, let's try to synthesize all this with a SWOT analysis. Strengths, weaknesses, opportunities, threats, based on everything we've discussed from the analysis.
Sounds good. Starting with strengths, that proprietary AI platform is key speed, scale, tackling hard targets. They have a proven track record, including gamlanimab and those 16 clinical programs from partners. Strong leadership with that huge insider ownership, lots of cash liquidity, many partnerships, and that integrated GMP facility.
Okay, clear strengths. What about the weaknesses?
Well, the big one is they're currently losing money unprofitable, negative cash flow. Revenue is volatile and drops sharply. Operating costs are high relative to current revenue. They depend heavily on partners succeeding. The stock price being so low is itself a weakness. And their own internal pipeline, while promising, is still pretty early stage.
Makes sense. And the opportunities?
Huge market for antibody drugs and discovery, and it's growing. Demand for personalized medicine plays to their strengths. Tech advancements in AI are a tailwind. That FDA shift away from animal testing towards NMs is potentially a massive opportunity. Their internal pipeline maturing could capture way more value, leveraging the GMP facility strategically, especially with trade issues, and of course, the potential for the stock to re-rate higher, given the low PB versus cash and those analyst targets. All right, and rounding it out, the threats.
Those U.S. tariffs we just talked about, potential cost increases, supply chain issues, intense competition is a big one, other platforms, AI firms, big pharma. Drug development is just inherently risky, high failure rates. Changes in healthcare policy or IP law could hurt. Market volatility hits biotechs hard. Partners could fail or cut back. They might need more funding eventually if the cash burn continues. And a key one, the risk their platform gets leapfrogged by even newer tech in this fast-moving field. So for you, this SWOT framework really helps balance the equation.
Exactly. It lines up the considerable assets and potential, the tech, the cash, the leadership against the very real hurdles and risks they face today. It shows the potential upside versus the significant challenges.
Okay, let's wrap up this deep dive on AbCellera.
So summing up the analysis, AbCellera is clearly an innovative biotech. They've got this powerful AI platform, strong, committed leadership shown by that high insider ownership, and critically, a big pile of cash giving them runway.
But on the other hand, they are currently losing money. Revenue is down sharply and volatile after the COVID peak. Costs are high. and they face all the usual risks of drug development.
And the market seems very aware of the negatives. The stock price is way down, price to book is super low. Analysts, though, see a very different picture, with high targets suggesting major potential.
So from that value perspective, it's complex, the valuation looks low, almost ignoring the platform and pipeline beyond the cash value.
Right. The potential upside hinges on that platform delivering consistent, diversified successes over time. And external factors like the FDA's move towards NAMs could really help.
But the risks we outlined, R&D failure, competition, tariffs, cash burn, they're very real.
Absolutely. The analysis frames this as a long-term play. You have to believe in the tech and in management's ability to execute this pivot towards sustainable growth. That high insider ownership is perhaps the strongest signal that they believe it.
And circling back to that initial puzzle, the stock crash versus analyst optimism.
The analysis suggests the current price reflects the pain of the transition, the revenue gap, the losses. The optimism and the potential value suggested by the low PB lies in them successfully using their platform and cash to build that diversified, profitable future. It's your classic high-risk, high-reward biotech setup.
So here's the final provocative thought for you to consider. AbCellera clearly possesses the technology and the financial resources. But can they consistently translate that cutting-edge science into medicines that are not only effective, but also commercially successful and sustainable? The path forward is outlined, but as always in biotech, that path is steep, winding, and full of unknowns. You now have a much deeper understanding of the climb they face.
If you found this deep dive into AbCellera helpful, please do like the video and subscribe to the Stock Analytics AI YouTube channel. We've got more analyses coming.
And don't forget that membership offer €4.99 a month. Give us a ticker, and we'll put a detailed deep dive on that company at the top of our list for you.
Just the usual reminders. This report is for informational and educational purposes only. It is not financial, investment, legal, or tax advice, and definitely not a recommendation to buy or sell any security.
This analysis was generated with AI assistance based on the source materials provided. While we aim for accuracy, AI can make mistakes or miss things. Always double-check.
Investing involves risk. You could lose money. Do your own thorough research. Talk to a qualified financial advisor before making any decisions. Past performance doesn't guarantee future results. Everything here is provided as is. Do your own research.